I felt that was like a bullet train.
Right. Hello and welcome everybody to your monthly analyst roundup. Russell, I can see, is very, very excited, waving his arms in the air. Thank you, Russell. So, thank you, everyone. And as usual, the format of this is we are going to go around each of the individual analysts, and the analysts will discuss their latest research of the month. Some very exciting opportunities and quite varied, I have to say. And then we will tackle the audience Q&A. So basically the community questions that all of you submitted beforehand. And thank you to all of those who submitted their questions. We will try to tackle those, well, as many of those as we can in the time. Now, like I said, we have a very interesting mix of research that we published in March from AI data centers in space. Yes, Elon Musk is serious about doing that. And we have an eye care specialist stock from Russell, and kind of sticking randomly with this eye theme is we have night vision goggles makers from Theodora, a company called Theon. So earlier this month, I wrote about a very fascinating slash science fiction topic, which is putting AI data centers in space. And this is, yeah, like I said, perhaps science fiction, but a lot of people, including Elon Musk, a lot of tech heavyweights, several companies are actually working on trying to get this, a reality. So what's the hype about? Why is everyone suddenly talking about putting data centers in space? Well, if you think about it, I'm sure we all know data centers on Earth, need two things in huge quantities, right? Energy and water for cooling, okay? And we are approaching almost the limits of that. So there's a lot of stories now of, data centers having to wait years to connect to the grid. There's a lot of, talk and debate about like the water consumption. Communities are pushing back on having data centers in their areas because it's pushing up, electricity prices, water prices, and you name it, and so on. So it seems like a bunch of tech people have said, you know what? Perhaps the engineering challenges of building these AI data centers in space is easier than trying to solve the Earth constraints of energy and water. So that's kind of why there is this hype at the moment. So the question is, how do AI data centers solve some of these problems? Well, first of all, the question of power, space has a lot of it. So actually, if you have satellites with AI data centers traveling in a certain orbit, then in theory they can get 24/7 sunlight, okay? And because you don't have this atmosphere and all that, you get much stronger sunlight when, you put a solar panel in space essentially. So basically, these satellites can harness the sun's power 24/7 and generate a lot more electricity than we can here on Earth when we compare a solar panel on Earth to a solar panel up in space. So it solves the power question. Then there's the cooling, which sounds simple in theory, and I'll explain why later on. But guys, space is very cold, right? So, so if you put these things over there, then in theory, it could make cooling easier through radiation panels, and I'll touch on that in a second. So third of all, data traveling through optical laser links. That data travels much faster in space through those laser links than fiber cables down here on Earth. And you also have to remember that we are already generating a lot of data up in space. If you think about weather satellites, GPS, maps, you name it, you name it. So there's this idea of having what's called edge computing. So why don't we put the data centers up in space, close to where the data is being generated, crunch the data, do what we need to do, and then only beam the final results back down to Earth. And then finally, you have regulations. So like I said, there's a lot of constraints at the moment in terms of building data centers here on the ground, but unfortunately, space is way less regulated, and that makes it easier for some people to launch, or want to launch these AI data centers in space. Now, the million-dollar question is this whole idea even feasible to begin with? And I hate to break it to you all, but, there's a lot of challenges and hurdles that need to be overcome. First of all, rocket launches aren't exactly cheap. Yes, launching stuff into space the cost of that has come down a lot, mainly thanks to SpaceX and their reusable rockets. But if you think about the size and the number of these AI data center satellites that we have to launch up there, if we compare them to, the size that we have over here, rocket launch costs have to come down significantly to make this whole thing, economical, okay? Second of all, I said earlier space is cold, yes, but actually space is very bad at cooling because space is also a vacuum. And if you think about your coffee mug that keeps your coffee warm, you've got a vacuum in between these layers of walls that keep the whole thing insulated and keeps your coffee hot. The exact same mechanism happens up in space. So you have these, computer chips or AI chips generating a lot of heat, and we don't have the same mechanisms, conduction or convection, that we have here on Earth to remove that heat. So what you're gonna have to do is build these huge radiation panels that basically beam out the heat as infrared radiation into the abyss of space. So yes, it can be done, but if you consider how much heat these chips are generating and how big these panels need to be on the satellites, again, it becomes a bit of a problem, and we probably need some engineering breakthrough in making radiation panels a lot more efficient. Third of all, you have a lot of cosmic rays and radiation that constantly bombard these computer chips in space. So the only way you can kind of counter that is you have to put a lot of protection on the satellite. But again, that increases the cost initially of putting the protection, and as well as it adds weight and you increase the cost of launching that satellite into space. Fourth, maintenance is virtually impossible. So right now, if you have a data center and one of the GPUs breaks down, hey, send an intern, replaces it, you're all good to go. How are you going to do that in space, right? It's going to be a lot harder, if not virtually impossible. Now, the big question is, how soon could this become a reality? Well, of course, if you ask Elon Musk, he says in 3 years, for sure, it will be the best and cheapest way to build AI data centers. A lot of people are a lot more realistic. They're saying, we'll probably see some trials this decade with perhaps some scaling up next decade. But there's a lot of risks as well because A, like I said, the costs really have to come down. B, if AI models become a lot more efficient, then there might not be the need to actually build data centers in space. Like the economics might not make sense anymore. So how do you play all of this? The honest truth is, there are some companies you can invest in to play this theme, but SpaceX is by far the biggest and like the most pure play on this theme. In fact, Elon Musk, merged his AI company, XAI, with SpaceX, and part of the rationale was, yeah, we're gonna put AI data centers in space. SpaceX, they dominate the launch industry, so launching things into space. And really, if you really want to play this theme, the only way to play it is via SpaceX. The bad news is SpaceX is currently a private company. The good news is that it is eyeing an IPO for the summer, and there are kind of like tangent ways that you can invest in it. And the further good news for all Finimize Pro members is that I will be working on an in-depth research piece, digging into SpaceX and whether you should invest in it ahead of its IPO, hopefully coming out in the next few months. So stay tuned. Now, without further ado, we're gonna go from AI data centers to a company treating eye diseases, I believe. But Russell, I'm sure you will tell us more.
Hey, Reda, thanks for that. Super interesting. And I'm really looking forward to reading more about SpaceX, probably one of the most exciting IPOs later, sort of this year, that's going to come through. So yeah, I wrote about Harrow, which is a pharma company that makes eye care medicines. Its strategy is pretty simple. It basically looks for FDA approved or late stage drugs that bigger pharmaceutical companies have decided aren't core to their strategy, or perhaps they don't have US domestic presence for distribution. So Harrow takes up the bandwagon and distributes it for them and pays these companies an upfront fee or perhaps licensing to kind of make it an economic sort of proposition that both parties like. So by doing this, it's managed to build up one of the biggest eye drug portfolios spanning what they sort of like multiple delivery methods. That includes eye drops, injectables, and sublingual, which is under the tongue type treatments, to reach a whole range of conditions covering all types, including dry eye, age-related macular degeneration, and cataract surgery. Basically, if an eye person or an eye specialist doctor needs something relating to the eyes to help, Harrow has something in their portfolio that kind of helps to do that and solves the problem. It's got three core drugs that last quarter accounted for 75%, give or take a bit, of its last quarter's revenues. And all three of those sort of growing at double digit or even triple digit revenue growth numbers. It's not just recently that's been growing fast. Over the last 5 years, revenues have grown at a compound annual growth rate of 40%. And EBITDA, which is like a metric of profitability, at 60% annualized growth. And because of that, the stock's done well, up 400%, give or take a bit, over the last 5 years. But the thing is, with high growth comes high expectations. So despite announcing 31% revenue and 36% profit growth forecast for 2026, and alongside pretty strong fourth quarter numbers, the stock actually fell 35% sort of last month after they came out with those numbers or forecasts. And that looks like a bit of an overreaction to me, or at least an opportunity. So the company sort of said, it's not the first time the company's missed, aggressive forecast, and it does have a bit of a reputation. But this time around, the company said it's bored of disappointing and getting stressed about missing these forecasts. So this time around, it set conservative forecasts, and I kind of tend to agree when you look at sort of the growth rates. And this is where it gets interesting in terms of the valuation. So using the management's new estimates for 26 and thinking that it's going to continue to grow at a pretty rapid 30% growth rate through to 2028, and then slowing down to 10% and then 3% beyond that, which seems fairly conservative. Using a discounted cash flow measure or analysis, you get with a $46 fair value against $33 today. So there's sort of reasonable upside there. If you want to look at it like on a price earnings ratio, this year's numbers it looks sort of still quite expensive, 61 times, but it's turning profitable for the first time on a net income basis this year. And because of that, with the operating leverage in its business model, that price earnings ratio is expected to drop sharply to 18 times for 27, 11 times for 28, and 9 times for 2029. And that looks sort of like reasonable value if it comes through. But what's interesting to me is on that base case, it looks reasonable. But there is a bull case out there. It's got a drug out there which could become a bit of a game changer for it. It's called Gmelt. It's a fast dissolving drug that you give under the tongue. And that can give doctors and surgeons a much simpler and faster way to kind of get reliable sedation and pain control for these short procedures. You see, Harrow's CEO, that's actually the founder of the company, has talked about his vision all the way through, about creating a version of cataract surgery that's IV-free, opioid-free, and eye drop-free sort of post-surgery. And Gmelt could be the final piece of that vision that he's got. You see, it's not some way out there kind of idea or concept that's got little chance of success. It's already being used and sold as a compound version. But what the company's doing, it's applied for FDA approval. And then if it gets approved, there's substantial upside. There's 4 million cataract operations or procedures in the US every year and 20 million globally. You see, the company's going for an international patent too. Not only that, if it really does work, which it seems possible that it could do, there's potentially other use cases for like dermatology, plastics, dental treatments as well. It can really sort of change the face of treatments. And that's pretty interesting to me. So that base case, you got 30, 35% upside. But if really Gmelt succeeds and they can develop the drug for like other use cases as well, that kind of gives it over the next 2 to 3 years a much stronger growth trajectory. And that's why I like it.
Really, really fascinating. And also, Russell, if I remember, I think it was last week, you also had an idea relating to gold miners, actually, which I forgot to mention in the intro, but maybe perhaps you can give us a little bit of an overview about that.
Yeah, that's right. Thanks, Reda. So this actually answers one of the questions from Harjeet, who sort of sent a question in to say, what are your thoughts on gold? It's meant to be a safe haven during turbulent times, but hasn't fared so well. And obviously he was thinking the same thing I was. So yeah, I was looking at it. And as Harjeet says, gold's historically acted as a safe haven asset and a hedge against inflation. But this time around, or over March, it had fallen around 15, 16%, despite the geopolitical turmoil, the war, and higher inflation expectations have kicked in from like this whole oil shock scenario that's kind of kicking in. Several reasons are cited sort of like or talked about to describe that. It could be because higher interest rates have undermined its attractiveness, as gold doesn't offer any yield or income to holders. Central banks have actually switched to net sellers after being big buyers over the past few years because they've needed to raise some cash to finance these increased energy and defense bills. And then add on, the dollar's actually increased in value this month, and traditionally gold price and dollar have an inverse relationship. And then finally, on top of everything else, you've got a momentum trade unwind. Loads of assets have come under pressure, and gold kind of, it's not the first time that when people have a dash for cash and want to take risk off, gold can get sold off too, at least initially. But I kind of think that expectation, I think that's kind of an overreaction and maybe an opportunity. So I kind of think that if the gold price could recover, if this conflict de-escalates or its haven status is restored once again, and that makes an investment in gold or gold mining ETF look like reasonable risk reward for me. And tying in with that, gold mining stocks that are typically leverage plays on the gold price, meaning they usually move in more percentages in the direction of what the gold price has done, look like it's an opportunity. And there was one gold mining ETF called the Vanet Gold Miners that actually fallen by more than 30% at one stage this month. So I added it to the Finimize portfolio as a bit of a diversifier and hopefully a haven asset.
Fascinating. And I have always personally believed that gold deserves a role in every portfolio. So thank you for officially adding it to the Finimize portfolio.
Let's hope it works.
Randomly with this eye theme is we have Nightvision goggles makers from Theodora, a company called Theon. So perhaps Theodora can tell us more about Theon.
Yeah, so I think I really like defense companies, especially in a market now that's terribly messy. And also, where companies are facing the risk of slower growth, higher inflation. I would say it's not exactly the best environment to be investing. That's why I think Theon is a great investment. It's a small cap company. It's worth, under 3 billion. It's Greek. It's a Greek defense company that's listed in Amsterdam and it's headquartered in Cyprus, so kind of all over the place. But I think what makes this a really interesting, potentially multi-bagger opportunity isn't just the sector it's based in, it's the specific kind of operational moats Theon has built over time. What they do, to keep it simple, is critical. So they produce night vision and thermal imaging systems, the kind of technology that literally determines whether soldiers can operate effectively in modern combat at night. So a couple of things. First, let's talk about the backdrop. As I've mentioned, global defense spending is no longer just a discretionary line item. You need it, right? Governments need it. And Theon has a very unique competitive edge in that they are ITAR free. And by ITAR, I mean the International Traffic in Arms Regulations, which is a US regulatory regime that very strictly controls, what defense-related technology can be exported. And so because they are ITAR free and their tech doesn't rely on these restricted US components, what this means is that they can export to a much wider global market. And they have far less regulatory headaches compared to their American rivals. The other thing that's interesting is their relationship with OCA, lots of acronyms, but it means the Organization for Joint Armament Cooperation. So this is simply the European intergovernmental body that manages the large multi-country arms programs. And so if you can secure contracts through OCA, what this means is that for a company, it effectively locks in its status as a preferred supplier for European nations for years to come. So it's a big deal if you can actually gain entry, and this is what Theon has managed to do. The second thing that's really interesting is their vertical integration, which is a margin machine. So vertical integration just means across the supply chain, you're kind of, when I say a backwards integrated kind of Company, it just means that you have secured your supply either through an acquisition or, you kind of have just learned, gained the ability to make it yourself. So I think what Theon has done is that they've controlled almost every step of the process, from the design to the final assembly. And so by doing so, what they've done is actually managed to lock in a supply that's quite hard to come by. And they've also managed to maintain very nice profit margins of around 20%. So unlike many growth stocks that burn cash in order to scale up, Theon is already highly profitable. So just last year, they grew revenue by almost 30%. And they look very well positioned to maintain this pace given their kind of 500 million euro order backlog that they've just acquired. And so, when things have looked pretty expensive, especially in defense, I would say that Theon actually represents a rare pocket of value for the main things that I've said. So, there's very high visibility because of their 500 million euro backlog. So, we're not guessing about next year's sales when everyone is now trying to guess if growth is going to slow and if inflation is going to hit sales. The second thing as well is operational agility. So they're much smaller. They're also vertically integrated, like I've said. So it allows them to pivot and equip, individual soldiers faster rather than the defense dinosaurs that we've seen, those large cap defense company names. And then lastly, I'll say is despite the growth, Theon is still really interesting. It trades at a discount to many of its larger, slower moving peers, much higher growth. For its growth profile, it definitely ought to be trading at least 50% more than what it's trading at now. So I would say kind of for those who are actually willing to look beyond the usual suspects and have a longer time horizon, I'd say maybe about 2 years or so, Theon actually represents a play on a necessary global trend, which is security. And it's also driven by a company that is executing at an elite level.
Awesome. Well, with that, I think it's time now to move over to the community Q&A. So thank you once again to everyone who submitted their questions. And yeah, we'll go through them in no particular order.
Yeah, and on that, please keep them coming in. It's super interesting for us to see and hear what you're thinking about, asking about, and wondering about. And sometimes it gives us an opportunity too to look into sort of a couple of areas that we haven't sort of looked into in detail before.
Yeah, so look, all of the Finimize model portfolios are designed as core allocations and they are all rules based. So the intention is to, for people to follow them systematically, which, increases the odds of reducing human error and behavioral biases, which, these are factors that extensive research has shown can negatively impact investor outcomes. So we have 4 model portfolios. One of them, the sector momentum edge, is a purely US stock strategy, but it's worth noting that the other 3 all have commodities exposure. So you were asking about commodities exposure in your question, and the other 3 all have commodities exposure. Obviously, the momentum-based strategies will only invest in commodities if commodities as an asset class is displaying positive momentum or is in an uptrend. The good news is they currently are, as you can imagine, with energy prices soaring and feeding into higher commodity prices everywhere. So the 3 other model portfolios, other than the sector momentum edge, so the easy rider, momentum rider, and the all-weather portfolio that has a trend filter, are all currently invested in commodities, and that's hopefully helping those strategies, offset losses elsewhere because of what we've seen recently because of the war. Now, in terms of what's a wise, investment approach, of course, this is all super subjective. So I personally, I wrote about the all-weather portfolio with a trend filter. Personally, that's how I allocate the bulk of my portfolio. I allocate it to that approach. And I think, for me, the sensible thing to do is to just stick with a strategy, especially momentum ones that will quickly take you out of asset classes that are performing poorly. So in this particular environment, obviously it's stocks, bonds potentially, but they're whipsawing, quite a bit. But by sidestepping deeper losses in these asset classes are trending downwards, you avoid deep drawdowns on the portfolio level. So I think that really the golden rule is if you have a very sensible investment strategy, which the model portfolios are, is to just stick with them. Now we are at the end of the month. That means a lot of these strategies will rebalance, and obviously exit asset classes are not doing well based on momentum. So we'll see when I run the numbers later on today, but I'd imagine a lot of them will exit equities or exit stocks. And in that particular case, then there's not much more you have to do if you are worried that stocks are going to continue falling. If, for example, in the Easy Rider portfolio, which is not a momentum-based strategy, it's a static allocation, has 60% allocation to stocks. If you're following that, and you are worried that, hey, stock markets could continue to fall, well, this is where hedging is super, super important. And you have many different ways to hedge. We've written about it extensively, but one of the simplest ways is to basically buy put options on stock market ETFs. And also one thing to bear in mind is implied volatility, which kind of tells you how expensive put options are. Okay, and the rule of thumb that I personally use is that, if the VIX index, which is a measure of implied volatility on the S&P 500, is below its long-term average of around 20, that tells you, hey, buying put options to protect you against the S&P 500 falling is relatively cheap compared to history, and you can just outright buy put options, so out of the money put options. So yeah, with a strike price lower than where the ETF is currently trading. If the VIX is really elevated or above its average, so I think at the moment, actually, let me have a quick look. It is about 30%. So that's above the average of 20, which is also understandable because there's a lot of demand to buy put options and protect against further losses. That increases the price of put options, right? And in that particular case, what I'd recommend is put spreads. And again, we've written a lot about this, but in a summary or in a nutshell, a put spread is basically where you buy an out of the money put option and you simultaneously sell another put option that's further out of the money, and you basically collect the difference. So because you're buying protection but simultaneously selling protection, that impact of high implied volatility kind of offsets itself, and it's just a cheaper way to buy protection when the cost of protection is already high because you're buying and selling protection simultaneously. So you're kind of being impacted by the high cost, but you're also benefiting by the high cost because you're also selling protection. Hopefully that makes sense.
Okay, yeah, so I think it's a legitimate question because especially seeing how the markets have done, it's always very tempting to kind of lock in your gains. The thing I always stress and have to remind myself as well is that I think taking profits is less about timing the perfect exit and so definitely not timing the market, and kind of more about having a clear framework before you buy. So there are three main ways I think about it. So first is thesis-based selling. And so that simply means that, if there is a specific reason you bought the stock, if it changes or it breaks, you take profit. So you exit and you lock in your gains or you lock in your losses, regardless of where the price is, where the price is. So, that could be a reason, weaker growth, or suddenly there is a change in regulation or in industry dynamics. I think over the long run, this is the most important discipline because it keeps your money aligned with your best ideas. But then again, not everyone has an idea or a thesis of why you bought something, right? The second thing I'll kind of think about is just valuation-based trimming. So if a stock runs well ahead of fundamentals and it's already trading at a pretty hefty PE ratio, for example, it can make sense to trim. I wouldn't say necessarily selling everything, but potentially kind of reducing your position and then recycling the cash into better opportunities. It's okay to have some cash on the sidelines because it just means that you've got more gunpowder, like potential to get into something interesting. And lastly, this is where I think it's really important. So when markets actually doing well, that's when you should potentially sell, not when markets are doing poorly like now. And I think that decision has nothing to do with the business itself when it comes to portfolio management. It's one that is more correlated with position size. Because say if you're bought into the S&P, it's 10% of your portfolio, and then the S&P continues to outrun all your other position sizes, and suddenly over 5 years you realize, oh, now it's 25% of my portfolio, or maybe more, and then you realize actually it's a bigger risk or an exposure than I like. Therefore, maybe I should lock in my gains now, and trim that so it goes back to 10%. So I think the overall tip and idea is I try to avoid selling just because a stock is up a lot. Actually, some of the best returns can come from just letting high quality businesses run and compound and do its things over many years. Yeah, I don't know, like Russell, Reda, do you have an opinion on this?
No, I think it all makes perfect sense. And actually, that's something I do all the time, which is basically write out in 3, maybe 4 bullet points what the investment thesis is whenever I buy into a particular stock. And if the stock price declines or falls a lot, I come back to that investment thesis and I retest it. And if the stock price has declined because the investment thesis has broken down, then honestly, you just have to swallow your pride, sell the stock, eat the loss, learn from it, and move on. And I think, the market doesn't care what price you bought a particular stock at, and if you're going to sell it for a loss. If the question ultimately is, hey, if I didn't own the stock today, would I buy it? If the answer is no, then just sell it.
Yeah, so with regards to the question on the world war and liquidating everything into cash, I certainly hope we're not entering the kind of World War III scenario. And I think your concern is completely understandable. But I do think that even in that scenario, going fully to cash is probably not the right response. So as I mentioned, the key thing is that investing is not about trying to predict extreme scenarios or timing the market. What you kind of want to do is to build a portfolio that can handle a wide range of outcomes, including ones that you might be wrong about. So right now it's very easy when things are going bad to focus on a worst case scenario, like a major global conflict. Like look back, across like the last 50 years, we have seen so many of those play out. We've seen COVID and everyone thought it's kind of, oh, the world's coming to an end and there are so many people dying. But at the end, sometimes, and actually many times, we are wrong about how outcomes can play out. So I think good investing is not about positioning entirely for the most severe outcome. It's about balancing probability and impact. And so rather than going all in on one view, which I think is you have a legitimate view to be concerned, I actually want to think of my portfolio in terms of resilience and diversification. So when I talk about diversification, I don't just mean diversifying across stocks and bonds. I also want to think about diversifying across different types of assets. So the way I'll term it is like paper assets, say like stocks and ETFs. They give you long-term growth and exposure to economic recovery. And then you've got cash, still paper and form, but they give you like better liquidity and optionality if you want to do something with it. The other way to think about it is real or hard assets like gold, commodities, or property. They tend to behave very differently in inflationary or stressed environments. And all of these different types of assets play a different role. And actually, if you do have a more negative view on the world, it can make sense to tilt more defensive. So either holding a bit more cash or increasing your exposure to real assets. But I wouldn't eliminate paper assets entirely because you might be wrong. And if things actually do stabilize, then these are typically the assets that recover the fastest. One last thing to add is that your time horizon also matters a lot here. So if you're investing over, say, a decade or more, going too defensive can actually be more damaging than helpful. So yeah, to sum it up, I would say the goal is not to perfectly protect against a worst case scenario. It is to acknowledge that it could be one of many different scenarios. And so build a portfolio that can last through the different types of scenarios. And so you can stay invested through uncertainty without having to liquidate your portfolio.
Yeah, so a good starting point, I mean, it's something honestly we talk about a lot, which is what we call a core satellite approach. So basically, you have a core, which is the bulk of your portfolio, invested in a sensible strategy, such as one of our model portfolios. And then you have the smaller portion called the satellite, where you can kind of think of that as like money I'm going to play around with, trying to buy individual stocks, to implement hedges, etc., etc., etc. In terms of where to start, well, also for the satellite portion, as Finimize Pro members, you have access to a lot of our research, all our research, should I say, and obviously we put out a lot of different investment ideas, so that's also a good place to start. Now, regarding the question of, what's a good way to screen for investment opportunities, I think honestly, before you even think about that, there needs to be some kind of self-reflection, which is a necessary first step. And I don't really mean that as a yoga way. What I mean by that is you need to first ask yourself, what kind of investor are you? Okay, so are you, for example, a value investor interested in undervalued, stock opportunities? Are you a growth investor where you're more focused on a company's growth and less focused or worried about, valuation levels? Are you a thematic investor, which I would probably group myself into? So I like to think about what are some really big, interesting themes happening in the world and what is the best way to play that theme. Because once you know what kind of investor you are or want to be, where your edge lies, by the way, because that's super important. Not everyone can be a value investor. Not everyone can be a growth investor. You need to find a style that suits your particular, personality and your approach. And once you figure that out, then you can, start to approach the question of investment screening. And investment screening, for example, if you're a value or growth investor, you can do that through online screens. So Finviz or Koifin, for example, have powerful stock screeners. For value, obviously, you're trying to screen for stocks trading a low price to earnings ratio, for example, or some other kind of valuation metric. And at the same time, you want to be adding kind of criteria there to avoid what we call value traps. So stocks are trading, very cheaply, but for good reason. So perhaps, they're extensively over leveraged, they have too much debt and so on. So you want to also add some criteria onto your screen where in addition to just being cheap, you don't want it to be cheap but be a terrible company as well, because you probably end up losing money if you buy into those stocks. Obviously for growth, then you're going to screen more for criteria in terms of earnings growth, revenue growth, profit margins, expanding, benefiting from operating leverage and all that jazz. And then of course, if you're going down the route of being a thematic investor, well, you need to start to research themes. So ask yourself, what are some interesting themes happening in the world right now? Even better, if you find some emerging or under the radar themes are not, as popular with investors right now, that means they won't be as expensive. Then once you have arrived at a theme, you have to think about the entire value chain involved in that particular theme and who's best positioned in terms of companies, who's best positioned to benefit from that theme and where the most underappreciated plays are. So that's kind of the way you should approach it. So before you think about investment screening, have a think and research different approaches to investing. Figure out which one makes the most sense to you. And then once you know that, then you'll at least know what kind of stocks to screen for in the first place.
Well, it's quite an interesting question. Yeah, I mean, the AI theme's been around for a while, and there is the idea of chasing the money. We've had running into memory stocks has been like one of the bottlenecks, and there's definitely been a little bit of talk more recently in the market about going into these optical based solutions where you come up with companies like Coherent or Lumentum, which are kind of hot stocks right now. But it's always very dangerous to kind of chase where the momentum or all the hot money's going, because it can come unstuck sort of quite quickly, and valuations can get stretched a little bit. So yes, you can kind of go there. I'm still a fan of the memory myself. They've come off the boil a bit, especially with that Korea trade, with the talk of like the war and the energy sort of impact for the Korean market. So that's a concern. But if you have a look at the Finimize portfolio, we've got exposure through nuclear power, other utilities ETF. We have a data center basket focused on the infrastructure side of where the spending's going. We've got a China AI portfolio. We want physical AI. We've got a humanoid robotics ETF that I've put in, and also a specialist play on the harmonic drives called Harmonic Drive, a Japanese name. Uh, and then, they've come off a long way, these big tech, and Alphabet's down 15 or so, maybe 20% off its highs, which have been reached on all these kind of spending concerns. But, Alphabet does have the balance sheet and it is making great headway across search and AI. So that's an interesting one, large cap company. And then, even Nebius that I've liked for like a long time, it's come off sharply with the concerns, I think, on credit rather than its outlook for its overall business. It keeps sort of like kind of writing new contracts. So, long term, I still like it. Short term, it's getting hit hard with just the sell-off and concerns across sort of like data centers. But I'm still a believer and think that it's going to execute well. And so that's a company I like too. So it's hard though, yeah. There's a lot of volatility out there, and the sector's dropped out of fashion a little bit as a whole. Although some of these sort of hotter names right now, these optical names are sort of like in vogue. I suppose one to finish off with is thinking about Nvidia. It's trading now cheaper than the S&P, 21 times earnings PE this year, 16 times next. So that's cheaper for the first time, I think, more than a decade relative to the S&P. Despite its size and dominance. So if you're still a believer in AI and think AI is going to be there, I am. Even considering Nvidia down at these levels looks like quite interesting risk reward.
So first things first, I'm gonna say congratulations that you have saved up 200K. Well done. Done well and you start investing. Okay, so your question is interesting because you kind of need the money pretty soon, so you don't have a very long investment window. So I think when it comes to investing, this situation really comes down to your time horizon and your objective. So if you know that you need the full amount in 2028, which is about 2 years away for a house purchase, your priority is probably not about maximizing your returns, but more about preserving your capital and maintaining liquidity. So what I'll say is that for me personally, I don't think stocks are appropriate for money you must use on a fixed timeline. So even if markets perform well on average, we could very easily see a 20 or 30% drawdown right before 2028. And recovering from that in time is probably very tough. So I personally would keep very little to no exposure to stocks, maybe, very like a 10% kind of exposure for this portion. The way I'll think about it is that I'll probably think about structuring my portfolio around stability and yield, with a focus on assets which I know are going to behave in a certain way over a short time frame. And by that, I mean cash or kind of short duration fixed income like bonds. They tend to work very well here. So, there are many options. You've got high yield cash accounts, money market funds. They kind of both provide liquidity and capital stability. I think where the picture actually changes now and where it becomes really interesting is the interest rate environment we're all in. So in markets like Australia, when I'm in, the cash rates are currently around 5%. Actually, that's super attractive, right? Because simply holding cash or cash-like instruments is already generating a relatively attractive low-risk return. The average kind of S&P return over the last decade has been around 8%. So I'm just thinking of like risk reward, actually 5% seems really attractive, especially if I need to take my money out in less than 2 years. So yeah, so I think in that context, there's just much less need to reach for yield by taking on additional risk. And actually the opportunity cost of staying defensive is lower for you.
Nice, Theodora, and I'll add to that. Let's say if you want to be guaranteed to have $200,000 cash in 2 years' time, and you can lock in a certain amount or the large amount at 3 or 3.5% or maybe 4 for those 2 years, then for that little 5%, you could take that around 5-6% and put it into stocks, because even if that goes wrong, you're going to be guaranteed to kind of get that 5% return on that chunk of, 190,000 cash or whatever it is. So you're going to be guaranteed to get 200,000, even if the market's imploded and went to zero in the meantime, if you locked in, that yield. So yeah, definitely you could, if you wanted to be sure just about having $200,000, you could put a small percent into the equity market and lock in the others in a 2-year money market fund where you're going to be assured to get a set return to guarantee yourself at least $200,000.
Yeah, so I mean, first of all, by my math, Momentum Rider was up 11% as of the end of February. So it was up 11% when you look at January, February. But it lost around, I mean, this is subject to change because of the time of the recording, but it lost around 4% last month. So it's still up around 7% year to date in the first 3 months. So that's still very, very solid performance. So just to put things into perspective. Now, I personally do not recommend, rebalancing based on the momentum scores more frequently, let's say weekly or something like that. So these strategies were designed with monthly rebalancing in mind. And I think it's tempting to say I want to rebalance more often because, that way I can get in and out of asset classes doing well or poorly quicker. But honestly, I can tell you, and you can even look at the research that backs this up, that if you start to do this more frequently, so if you start to chase momentum signals on a much more frequent basis, let's say weekly or God forbid daily, what's going to end up happening is you're going to be really caught up in market volatility and you're going to get hurt a lot when you have whipsawing markets. So when they go up, down, because again, if you're moving in and out of asset classes every week based on momentum, let's say, for example, stocks go up, then you buy in, but then they go down the next week, so you sell, then you exit, then they go up and down, and you can end up losing a lot of performance. So I think monthly is a lot more sensible. It ignores the day-to-day noise, the week-to-week noise, and really kind of zooms out enough to keep track of the bigger long-term picture. But monthly is still frequent enough where, yes, you might miss out or you might still be caught up with an initial sell-off as an asset class, but at least you avoid the really, really deeper drawdowns. Yes, when something rebounds, you will miss the initial uptick. Yes, for sure, but at least you'll capture the rest of the upside. So from a risk management perspective, honestly, it makes a lot more sense to keep following this on a monthly basis, and I wouldn't recommend trying to rebalance more frequently. Now, in terms of the question of following the rules, as I mentioned earlier, so Momentum Rider, similar to all the other model portfolios, is rules-based with the intention of being, followed systematically to minimize human error, to minimize behavioral biases. These are factors that, research has shown can negatively impact investor performance. So honestly, the best approach is to stick to a strategy. And if you're worried about something, so let's say the strategy, in the middle of the month is invested in stocks, but you're worried about, the stock market in light of the war and all that, well, you implement hedges. And we've discussed about hedging, a lot in the past, but, like I said, through the simple use of put options, you can implement hedges and you can hedge out or neutralize the effect of stock markets keep going down while you're invested. And then at the end of the month, if this particular portfolio, let's say Momentum Rider, moves you out of stocks, then you also have to reconsider, do I still need the hedge? Because you only need the hedge if you're invested in something and you're worried that that particular thing will do well. But if you've been kind of shifted out of stocks and you have a put option in place, then now you are actively taking a betting that stocks will continue falling. Which, I mean, up to you if you want to take that bet or not, but just it's important to understand the relationship between your hedges and what you actually own in your portfolio.
Yeah, so I like how you're thinking long term. That's how I invest, and I think that's really the key. But obviously, there are different styles of investing. You kind of pick what works best for you. So when I think about long-term ETFs in today's environment, I would still start with a very simple core, kind of broad global exposure through something very basic like the Vanguard Total World Stock ETF or the MSCI Index for international shares. because I think that owning global growth in your portfolio over time is still a very reliable foundation. And then when I think that I've got my core portfolio sorted, I then would like to layer in a more quality and cash generation tilt for the longer term. So one that I really like is the Pacer US Cash Cows 100 ETF. There is also the global version of that, which is very interesting because what the ETF does is that it focuses on companies with very high free cash flow yield. So typically businesses like that are already profitable, they're very disciplined with their capital, and also they are less reliant on external financing. So when we're talking about a higher interest rate environment in a more uncertain world, you want companies like that who are already profitable, who already have self-funded growth. And then alongside that, after adding, high quality companies, just based on cash flow yield, I also like adding a bit more of a traditional quality factor through something like the iShares MSCI USA Quality Factor ETF. Again, it's not just kind of isolated to the US. You would have a quality factor tilt for other segments or other regions in the world as well. And what this ETF does, what the quality factor does, is that it screens for high return on equity, stable earnings, strong balance sheets, again, kind of tilting towards more resilient, well-run companies. And then lastly, on a slightly different but complementary angle, I actually do quite like the Van Eck Morningstar Wide Moat ETF, which focuses on businesses with durable competitive advantages. So companies that Morningstar believes can sustain excess returns over long periods. So what I like about this approach is that it's not just judging a company based on its current profitability. It's looking at the long-term defensibility and pricing power of a company. So when you put it all together, you're not just buying the market, you're also layering in exposure to companies that generate cash, they allocate capital well, they have strong balance sheet, they have structural advantages, which I think if you're investing for the long term is a particularly strong combination in today's kind of macro environment.
Merci, George. Thank you so much. I really appreciate that. So to answer your question, look, you're absolutely right and you're asking the right question. So a shift to a multipolar world is happening, but it doesn't necessarily require a wholesale change in your investment strategy. But it does change where the risks and opportunities are, and it is definitely worth thinking about. So if you think about it, the past few decades, really portfolios have been built around a relatively stable US-led global order characterized by deep globalization, predictable trade flows, dollar dominance, you name it. But of course, if that whole thing is being flipped upside down, we're moving towards deglobalization and a multipolar world, that introduces more fragmentation, geopolitics start to matter more as supply chains become more regionalized and capital flows can be used as tools of weapons, essentially. Now, from an investment perspective, a few adjustments become important. So first of all, really, really important is broad geographic diversification. So rather than assuming that the US stock market will continue to dominate and outperform international markets, I think it makes a lot more sense to have a more balanced approach and a more balanced exposure to many different regions, particularly economies benefiting from supply chains realignment. So we're talking about things like India, Southeast Asia, and parts of Latin America. Second of all, focus on strategic sectors. So governments are increasingly prioritizing resilience over efficiency. The old model is global supply chains. I will source or I'll do my manufacturing wherever it's cheapest and most efficient. That framework is no longer the New World Order. The New World Order is really governments prioritizing key areas, key industries, and making sure they happen within their own borders. So think of things like energy security, semiconductors, defense, critical infrastructure, cybersecurity, you name it. And actually, for those following, my research, I've talked about nuclear energy a lot. And actually, I think nuclear energy as a theme is going to emerge from this particular conflict even stronger, right? Because you have a lot of countries dependent on fossil fuel imports for their energy needs. but nuclear is a lot more domestic. Uranium prices are way less volatile. Also, if you think about it, you can store years and years of nuclear fuel as uranium in a very limited physical space, a small space, because uranium is very energy dense. So from all the energy security kind of checkbox, nuclear really ticks that, and I do expect the theme to do even better in light of the current crisis. Third of all, inflation. So in a less globalized world, you can expect the world to become more inflationary. So like I said, instead of outsourcing manufacturing to the cheapest region, now it's about having manufacturing, especially if key industries, domestically. So that could lead to more inflation. So it's important to make sure your portfolio has assets that perform well or help protect you against rising inflation. Think about real assets like commodities, gold, infrastructure, and potentially real estate. And even for the bond portion of your portfolio, you can think about inflation-linked bonds as well, which could also help in that environment. Fourth, think about currency and be aware of your currency. So while the dollar probably won't be, displaced anytime soon, but currency volatility is the name of the game. And actually, if you look at last year, 2025, the US dollar did really, really poorly. So if you are a European or a British investor investing in the US, your returns were even worse than what the stock market did, because you, on top of, how the S&P 500 performed, you also, were harmed by a falling US dollar. So when you convert your money back into your own home currency, you were really harmed. So it's very important to think about your currency exposure. And one quick and easy way to do this is that if you're investing in exchange traded funds, a lot of them have currency hedged share classes that basically hedge out the currency exposure. I'd say this is even more important if you're investing in bonds through bond ETFs, because, when the bond ETF can generate a 5, 6, 7% total return, based on the yield and price movements. But if the dollar, for example, goes down by an even larger amount, it completely wipes out your gains. So really think about your currency exposure. And last but not least, geopolitics is no longer a tail risk. It seems to be like the only constant in life these days. So really treat it like a baseline variable. Consider 3 layers of protection for your portfolio: diversification, implementing trend, so through the momentum strategies we discussed, and then obviously hedges through put options and you name it. Awesome. That's a wrap. Thank you so much for tuning in. Thank you again to everyone who submitted questions. Like Russell said, keep them coming. It's really, really interesting to see what's on our community's minds. Thank you once again. Hopefully this was helpful, and we'll see you at the next one. Have a good day, everyone.
Bye, guys. Thank you. It's been such a lovely time. And thank you for sending our questions in.
Nice. Thanks, everybody.